Welcome, everyone, and thank you for joining us for today's webinar. I apologize for the delay. There is a little bit of technical difficulties. My name is Chris, and I am your host as well as the marketing manager here at EBS Associates. Today, we are presenting lesson 5 of our 6-part cash flow webinar series presented by Mike Milan. As always, just a little bit of housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel, and I will try my best to answer them, or I will bring them up to Mike during the presentation. There will also be a Q&A at the very end. If you do not have the slide deck and you want to follow along with Mike, please let me know, and I will email that over to you right away. And now, without further ado, here is Mike Milan.
Hey, Chris, you call that technical difficulty, but dude, I'm telling you, I'm a mess today. I mean, look at this sunburn. I don't know what happened, but you guys couldn't hear it on the broadcast. But somehow I turned on a narrator on the computer, and everything I moused over, it read to me. So, and I couldn't talk over it. I couldn't shut it off. I didn't know what to do. But here we are. So please don't be blinded by the sunburn. Maybe you can mute the color on your screen, or maybe we'll Photoshop it later. I don't know how it works. but anyway, I'm ready to get started. This is lesson 5. Lesson 5. If you guys remember, we were talking about Sammy Spectrum of Spectrum Manufacturing, a paint manufacturing company in Wentzville, Missouri. And we were going down through. He has a request out there for $300,000 in a line of credit. He seems to think he's going to get a true value contract worth $3 million, and thought about 10% of that would work. Now, what we found out last week is that when we did the ratio analysis, he's got some problems, right? He's got some problems with gross profit. He's got some problems with regular profit, sales. We identified several problems within his ratio analysis of his company. And then we also looked at his working capital cycle. And his working capital cycle, or his cash conversion cycle, showed us that his request for $300,000 wasn't going to be enough. The way his money moves through his business right now, it just wasn't going to be enough. So even if he got the contract, it would be too little of money, and he'd probably do what we call grow broke, which means your orders are coming in, but you can't satisfy the orders, and you just kind of get overwhelmed. All the cash gets sucked out of your company. If you remember, the working capital cycle formula is inventory days plus AR days minus AP days gives you the cash gap or the financial gap. And then you divide your cost of goods sold by 365. And when you do that, it gives you an average daily balance of cost of goods sold. That's the amount of money. When you multiply the daily cost of goods sold average by your cash gap days, that gives you the line of credit that you'll need, or at least access to cash. Doesn't always have to be line of credit. You can have cash and a line of credit, or just cash, but it tells you how much you need to run your business successfully. So when I've talked with business owners over the last 4, 5, 6 years, it always comes back to ratios don't matter to them. They don't get excited about a current ratio of 2.0. They just don't. They don't care. Ratios mean nothing to a business owner. That's why I go a step farther, right? So what we're going to talk about today is the financial impact of the way they're running their business. Now, it's called financial impact here on the screen. I want you to look at it and think about it in this way. This is a metal detector for your company, right? So think about, we're combing the beach, we got our metal detector, and we're finding hidden treasure. This is hidden cash inside the business, right? It's hidden opportunities to make more money just by doing adjustments either up to our target or up to our industry average. When you see target on the screen, we use to analyze Sammy the industry average. So this is what it means. We're going to go through, there's 6 different opportunities. I call it, there's a cash impact, and I'll show you how to evaluate these, but the cash impact of every decision that we make. So let's talk about gross profit. We're going to take what he's actually doing versus if he was an average company. If you remember, he had like a 30% cost of goods sold, whereas the rest of the industry had a 32% cost of goods sold. That 2%, what does it mean? Is it really a big deal? When we analyzed it, we thought it was fair. He's kind of in the ballpark, so we didn't pay much attention to it. But here's what it means in dollars, right? So what we've got is Sammy's. We're going to take sales to multiply it by the target, which is the industry gross profit. So we got sales of 7,100 multiplied by our target gross profit margin of 32.2. These numbers are coming from last week's lesson, right? These numbers are coming from last week's lesson right off the ratio analysis worksheet. 7,100, or it's really 7.1 million, but we're just rounding and using, dropping off the thousands. So we've got 7,100 times 32.2 gives us target gross profit of 2286, 2.2 million. So if he was an average company, if Sammy was running average, he would have had 2.2 million, almost 2.3 million on $7 million in sales. So we carry that down to our target gross profit and compare it to what he actually did. So 2.2 million, subtract out the 2.2 million that he did, 2.1 million. So it's 2286 minus 2180 gives us a financial impact of 106. So yay, I got a 106, right? That's what we got. Yes, that's what we should be doing is yelling that yes, it's $106,000 more that he can get. Think about it this way. If he was average, he'd have $106,000 more. Since expenses are already paid for, he's already got it covered. That goes right to the bottom line. So really a 1% bump because it was like 30.7 was his actual number, which gives us a, well, let's see, 30.7, 1.5%. He needs 1.5%. 1% gives him $100,000. Here's how I'd go get it. If I was consulting for him, I'd say, hey, let's call all your vendors right now. And I'd get on the phone and I go, hey, yeah, we're kind of in a cash crunch over here. I'm going to need about a 15% haircut on all my price, all my products. I mean, you're just going to have to give me a little bit of break here. We're going to renegotiate. And of course, what the vendor's going to do is say, oh, no, I can't do that. I can't give you 15%. Maybe I'll give you 7. If they get to 7, if they get to 5, if they get to 3, remember, 1% gives you $100,000. So if they give you 5, that's $500,000 that you're going to have based on the way that we're evaluating that. So what we want to do is be able to look at what we're doing, compare it to average, and then become at least average or better. So that's a positive $106,000 that we could gain. Where he is, he's negative though $106,000 because he's behind the industry. So let's talk about profit. Remember what we said last week is that this guy is practicing working. He's not doing it for money. He's not doing it for profit. He's actually just going through the motions because he only has less than 15 basis points. That means 0.15 is his percentage of profit. Percentage of profit before tax. So when we look at it, we still got sales of 7,100, 7.1 million. Everyone else in the industry makes a little bit more than he does. They make 3.1%. So if we did that, if we could just be average, we would have made $220,000, $220,000. Now remember, this starts off though that you're also average 106, right? So 106 of that 220 actually comes from gross profit. So the remaining, what is that? 120 minus 6, 14. So 114 comes from operating expenses, right? He's too high on operating expenses by 114,000. So if we take our pre-profit tax of 220,000 and actually subtract out what we made, which was 11, think of the difference there. The average company brought in 220,000. We brought in 11. So our financial impact is, of course, $209,000 total. 106 of it comes from gross profit. The remainder of it comes from operating expenses. So now you can say, how much should you cut? It's fine to say, hey, your operating expenses are too high. This tells you how much they should cut. And when I look at it that way, how much I should cut. Let's see. I'm going to turn on the screen sketch and kind of draw it out for you. All right, so we got the 106, so 209 minus the 106, because that's in your gross profit, equals 103. That comes out of operating expenses. If you remember in the mini P&L we've done in the past, we got sales minus cost of goods sold equals gross profit. Then we subtract out operating expense equals net profit. That 103 is how much or how high his expenses are. So if I'm being a consultant, I'm talking to him and say, hey, listen, your expenses are too high. He goes, well, how much is too high? It's $103,000 too high. Now we have a target to cut down to. So that's one of the ways you can look at that equation. Okay, how about sales? All right, when we talk about assets in the past, we talk about the only reason to buy an asset is to actually generate revenue and profit. That's it. There's no other reason to buy an asset in business. So when you're generating sales, we came up with a turnover rate of, for every dollar I put into a piece of equipment, how many dollars in revenue does that generate? And ours came up to, Sammy's came up to 1.9. So $1.98 for every dollar he invests in equipment, it generates $1.98 in sales. But the rest of the country, the rest of the industry, actually generated more than that. So we have 3.6 million in assets. And if we look at the turnover rate for the rest of the industry, it was 2.3. So for every dollar our competitors invest in equipment, it generates $2.30 back in sales. So if we was to do that, we would have had sales actually of 8.3 million. 8.3 million. So this is really critical. It's critical in this sense. When we compare it to what we actually did, we should have done 8.3. We actually did 7.1. That gives us a low sales number of 1.2 million. All right, 1.2 million more. This is good from a opportunities perspective because this is actually money that we can generate without investing in more equipment, right? This is underutilized equipment. This is the proof. This is showing you that just by increasing sales, I don't have to make another investment in equipment. Sometimes you hit a capacity, sometimes you hit the wall. In this case, we're saying we can at least do 1.2 million more with the equipment we have in place. So if I was going to buy the company, and like I've said in the past, when you buy a company, there's two purchases. One is the actual purchase price of the company. The second is the capital investment you make. Because once somebody decides they're going to sell, a lot of times they don't maintain the equipment as well. They let it get older. They don't replace it. So there's probably a capital equipment expense that comes on top of the actual purchase price itself. So in this case, we've got, if I can use that pen. Can I use that? Yeah. We've got opportunity here of 106 in gross profit just by looking at your vendors a little bit harder. You got 209 in net profit, right? So if we go back and renegotiate with our vendors and we cut some expenses, we could have $209,000 more. And then of course, once we're healthy, we can actually start to increase sales, and we can do so without having to make another capital improvement. So good. So that's the first page. Now we're going to look at the working capital cycle. Turn this pen off. Back to drawing mode. And look at the actual, those circles stuck on there. There we go. All right, and we're going to look at the actual working capital cycle. The same stuff we worked on at the end of last week. Inventory, AR, AP, the cash conversion cycle. Are there opportunities for us to improve this portion? And this is where we're going to look at it. On inventory, we're going to look at cost of goods sold. Remember, the inventory is an asset until it's sold, then it becomes the expensive cost of goods sold. And we're going to divide that by our target turnover rate, which means how fast do our competitors sell their inventory. And in this case, it's 5.5 times a year. So that's where the turnover comes in. Now, we took it a step further and converted it to days, where it was like 44 days, or I'm sorry, 66 days of inventory. But we got 4.9 million in cost of goods sold. And if we turn that over 5.5 times, we should have this much inventory on the shelf. This is how you're going to read this line. It tells us how much inventory we should have. We should have $895,000 in inventory. If we're going to be average, that's what the average company has on the shelf at any given time. What do we have on the shelf is what we compare it to. We want it to be 895. We actually have 1.2 million. That's too much inventory. It's telling you that right now. The rest of the country, the rest of your competitors can get by running their business on $895,000 in inventory. You've got 1.2 million, and the financial impact is $322,000. This is saying you've got dead money sitting on the shelf. One of the things when I'm talking with bankers, we say that an actual reduction in inventory actually improves cash flow. And the way it does that is what you would normally do when you sold a piece of inventory, you'd replace it, right? You'd actually make another order and replace what was sold. By bringing down your inventory levels, you actually put cash, you keep that cash in the company. It's called a source of cash from a banker's point of view, and that actually puts more money in the owner's pocket. In this case, reducing inventory will put $322,000 back into cash flow. Super important because he asked for 300. He doesn't need the 300. What he needs to do is just sell the inventory and not replace it, and he'll have it. So he doesn't need a loan. There's one way that we can get $300,000 for him right there. All right, and then accounts receivable. This is saying, and if you remember right, we're actually better than our competitors here. We're actually better than the industry average. But this is saying, how much should I be owed if I was average? So on sales of 7 million, we should be turning over our accounts receivable 8.3 times. So we should be getting paid 8 times a year by our customers. And if we did, we would have about $855,000 owed to us. All right, we'd have $855,000 owed to us. By what we have, though, actually, whoops, I guess I'm gonna undo all the rest of them first. Funny. I think I just goofed that up. There we go. Building saving. Nope. There you go. Where are you seeing the sausage being made today? Oh, I can't do that. Okay, what we have actually is, it's there. I just can't move it for some reason. Technical difficulties. Okay. Apologize for that. Get these back in. All right. So now we're back up to speed. We got 855,000. What we should be owed, we're actually owed 654,000. That means we're positive. We actually have $200,000 more in this instance than our industry, right? So we're actually above average. That's a positive impact to cash, being above average. And so we've got 106 on gross profit. We've got 209 net profit. We've got 1.2 million in sales, negative 322 in inventory, and 201 in AR. Now AP, this is how much we should owe, right? Owing our vendors AP, 4.9 million in cost of goods sold. In this case, for these ratios to work, I see accountants all the time, they'll put everything into AP. You can do that, but then you should separate out what's actual cost of goods sold. All right, so for this to work, you can't put in your rent, you can't put in your electrical bills, those type of things. But 4.9 million on a target receivable of 10 times, we're going to pay our vendors 10.8 times a year, which means we should owe about $450,000 at any given time to our vendors, in this case for our inventory. What we actually do owe is $750,000. So in that case, we have a financial impact of almost $300,000, $294,000. This may look weird to you, but it's positive. It's actually better. We're actually better than the industry. Even though we owe more, doesn't mean that we owe more. Owe more means we still have the money in our pockets, right? We haven't given it away yet. So a bank would look at that and call that a source of cash because the money's still in the company, right? So an increase in a liability is actually a positive impact to cash. All right, so let me kind of show you a couple things about this, right, and how to look at it and how to interpret it. I'm going to make a little drawing here based on what we just did. When I'm explaining this part to business owners, I do what's called a cash impact map. Right, the cash impact map, put a negative on one side and a positive on the other, right, for the cash impact map. Over here, I'm going to just outline the things we did. We did gross profit. We did net profit. I'm trying to draw with my mouse. Net profit. We got sales. And these are the places we're looking for hidden cash. And the next one was inventory, AR, and AP. And when I draw it out like this, a lot of business owners get it really fast because it's going to show them where to look. Now, we were behind. We're worse than the industry in gross profit by 106,000. So I just draw a little bar graph off of industry average is the center. We'll call that a 0, but 106 here. Then net profit, we were behind the industry by 209. So I make that a little bit longer just to show that it's longer than the other. Not the scale, by the way, not the scale, but it's longer so we can see. 209,000. If you remember, 106 of that is also in the gross profit. Then we were behind like $1 million in sales, like 1.2 million. We had inventory, we were behind 320,000, 322. Then we were actually better on AR. We were better by 201. And we were better in AP by 294. All right, so the way we look at this is these are the places where we're behind the industry. And if you don't know where to start, if you don't know where to start putting cash back in your company, you don't know where to start to find it, I say look for the longest line on the negative side, right? And I would color code these red and green. So just look for the longest red line, red being on the negative side, green being on the positive side, and start there. Of course, we can increase sales, but that's always the hardest one. I'm going to tell this guy right there is his biggest problem. And we can see it visually. Reduce your inventory is going to put $322,000 back in your pocket. And at the same time, we can renegotiate with our vendors, try to get at least that 1% back. And if we do that, we can get $106,000 in profit from the gross profit line, and then cut another $103,000 in expenses, and boom, we're back to average. So if you don't know where to start and you want to find hidden cash in any company, do the financial ratio analysis the impact map, and see where you can go find cash in a company. Okay, turn that off normal, non-drying those now. So what does that mean? What does that mean? Actually, I want to go back. I want to go back to that. Because before I get to the cause and effect, how things impact each other, I don't think I've really explained how. We're talking a lot about debt. We're talking a lot about financing, lines of credit. A lot of folks just don't know what that means. All right, so what I want to do is go back and talk about debt structure. All right, we're going to talk a little bit about debt structure. And here's the thing about debt structure, and I blame this on my mom. If my mom would have asked me a different question or talked to me a different way in junior high school, I would have known this a whole lot sooner. But instead, it took me until I was an adult to figure it out. Because in junior high, my mom, I come home from school and she go, you know what you should be? She said, you should be a doctor. I'm like, going, a doctor? So I'd go to school and I'd get my report card, and the scores would come back for biology and chemistry, those type of classes. And she'd look at my report card and go, maybe a dentist. Maybe you could be a dentist. And we went all the way down the list. She said, oh, maybe a doctor, maybe a dentist. Well, maybe you can be an accountant, chiropractor. It was anything but those. I mean, those never fit when she looked at the scores. I mean, her last straw was, well, maybe you should just be a lawyer. Well, that didn't work out either. But if you look at all the things that she asked me to do, they're all kind of service-oriented businesses that really don't use debt structure in the same way. I mean, they can, but you don't see it initially. Let me kind of explain how debt structure can be used in a better way, and how you can structure debt in a small business. So, for some reason, that thing's always there. There we go. We'll use the workspace, go to screen sketch, and then boom. Okay. We're looking at the actual debt structure of a company. Here's how you should do it. And I tell you, if she would have asked me one more question, like, you should be a beer distributor, I would have got it, right? I would understand debt a lot better than I did right now. But instead, she went doctor, lawyer, all those types of things. But if she had said a beer distributor, I mean, think about it. When you drive up to the building of a beer distributor, what do you see? right? What do you see? Yeah, buildings, you've got trucks, you've got forklifts, you've got office equipment, office furniture, those type of things. But you have things, right? So here's how I start to describe debt to small business owners, right? Make them make a kind of a graph, almost like a Sudoku type puzzle, kind of a graph, and yeah, looks like that. So if we're looking at it, give me an XY axis, extend out a couple lines. You can label it, 1, 2, and 3. So the 3 levels of debt that we're working with. Up at the top of this first one, we're going to call it financed with. That means the product that we're going to use to pay for this, financed with. And then we're going to do paid with. This is where the money comes from to make these payments, right? Paid with. So financed with is the loan product. If you got cash, this is irrelevant. I'm just saying if you're going to take on debt, this is the way you should do it. When I talk about the beer distributor, when you go in, you see things, and we talk about forklifts and the likes. That's what we call our gross fixed assets. Some companies might call it PP&E, property, plant, and equipment. Other companies, I've seen it called FF&E, which is furniture, fixtures, and equipment. It doesn't matter what we call it; it's just stuff, right? It's just things, right? Physical items that we need to run our business. I think everybody on the call knows how to finance those type of things. You're just going to use a term loan, right? And if you remember, the rule for term loans is the life of the asset should match the length of the loan. So if I can depreciate something for 7 years, I should get a 7-year term loan. So it's a term loan, right? Now, most people don't know where the money comes from to make this payment. But the money actually comes from retained earnings, right? We can call it net profit, but if you remember the way we talked about it, it becomes after the month is over, whatever's left, you make your loan payments with that money. So it's net profit, then gets transferred onto the balance sheet in the form of retained earnings. But that's where the money comes from to pay for those term loan notes, right? So when the bank's looking at it, that's why that number is pretty important, because they're looking to see, can you service it? That's why we use EBITDA as a way to determine cash flow. Now, the next two are a little bit harder to understand for some people, all right? But I'm going with the beer, right? I'm going with the beer scenario because people get it. If you walk into any grocery store, convenience store, anything, you always see a certain amount of beer on the shelves, right? Neatly faced, really nicely stacked, no empty spots. They're always right there. Everything's all lined up. And you always have enough to get through at least a week, right? And that's the way the cycle goes. The order cycle is going to go. We're going to have just enough so I don't run out, right? And that's called base level or permanent inventory. Base level or permanent inventory. Base level or perm. This is if you've heard the term par. How much should you have on the shelf? Well, it's enough so you don't run out, right? In one of my restaurants, what I would do is, I'll just use Budweiser. I'll just use one line Budweiser since we're talking about beer. I always had 12 cases. Didn't matter. Every week I wanted 12 cases. I wanted to start the week with 12 cases of Budweiser. If the week before there was 4 of them left in the walk-in cooler when the Budweiser rep came around, there was only 4. He would order me back 8 to put me back at 12. He knew to order up to the 12. And it just so happened, just on any given regular week, 12 was enough. I may not sell 12, but I never ran out, right? So, so 12 was kind of where I set that. Now, base level permanent inventory, if you do this right, these next 2 steps, if you do this right, you will only ever have to pay for your inventory one time, right? The rest of the time, you're going to use the cash conversions and the sales to replace the inventory. But if you do this right, you'll pay for your own inventory one time, and you're only paying for the base level or permanent inventory. Now, to buy this, you use a 5 to 7 year term loan. 5 to 7 year term loan. And of course, we know that you pay with retained earnings or net profit. But that's only part of it. You only buy the first 12 that way, right? The first 12, because after that, the customer buys it. So when I said that there was 4 in the walk-in cooler, the next 8 I bought was with the money I received from the customers to replace it, right? So when I sold the 8, I took the customer's money I bought 8 more. Whatever was left goes into, of course, my operating expenses. So the replacement, and that's why I drew a line here, the replacement is the cash conversion of sales, CCS, and we use the cash conversion, right? Cash conversion of sales, meaning we're replacing it with the other people's money. So that's the first level. And you're like, oh, Mike, that doesn't work all the time, or I can't get a loan of inventory. SBA does give loans on inventory, but there's other things we can do. We can structure, we can secure a piece of collateral. Somehow you take the original value of your base level and secure it with a term loan. It makes your inventory payment flat. And at the end of 5 to 7 years, you've bought all your inventory and you'll never have to buy it again, right? Because you're using the customer's money after that. If there's an increase in base level, of course, you need to finance that. But here's what happens throughout the year, right? We got our regular weeks. We never run out at 12, but occasionally we sell more than that, right? Occasionally we sell more than 12. Some days that pop to mind, of St. Patrick's Day, Cinco de Mayo, you've got 4th of July, Super Bowl. When you go into the grocery store, you see, you're like, oh yeah, there's a big event this week, because they build structures, they build tents, and they build, things you have to crawl over just to get the checkout lane. I mean, the end caps come out. I mean, there's more beer than normal, is what we're talking about. And do you know it's actually 4th of July is when they sell the most beer. The busiest bar day of the year, just for common knowledge, is actually the Wednesday before Thanksgiving, right? It's like everybody comes home, the first thing they do is go meet up with their friends, or I guess probably try to get loosened up for a day or two with family. But it's the business bar day is that Wednesday. What do you think is the lowest selling beer day of the year? Well, I'll tell you what it is. This is Valentine's Day. Valentine's Day, they sell the least amount. It's probably because guys, put down their beer for that day and they pick up a glass of Chablis, because they're being fancy and being romantic. So that's probably why they sell less during those times than others. Okay, what I'm talking about here it is, Super Bowl. We got St. Patrick's Day, Cinco de Mayo, 4th of July, Memorial Day. There's more on those days where we don't need 12 cases, but we bring in 20 cases, right? So we already have our 12 that we bought with our base level inventory. The next 8 cases, we're actually going to use our line of credit. This is where you use the line of credit. You've already bought your base level. You got up to 12. Then you take the 12 to the 20. This is what we're going to order over and above the top is the 20. So the next 8, I'm going to use my line of credit. As soon as I sell the next 8, I'm going to take the cash conversion of sales and pay down the line of credit. After Dodd-Frank, you've actually got to pay down that line of credit at least once per year and let it rest, which means don't draw on it for 30 days, right? That's one of the rules that we put in place to help businesses not get swamped. The easiest way to do that, and your bank will love you, is only use it for the seasonal items. The seasonal is what we call this is seasonality. When you're buying more than your base level, you use your line of credit for that amount and then use the cash conversion of sales. Here's what happens to people, right? And you can think about it from your own personal credit card. Your line of credit, the way we just calculated it, is designed the limit to meet your business needs, right? This top level. Let's say it's $100,000. If I need $100,000, that means I need it to actually buy my 20 cases of beer or whatever your number is. Some people won't use it properly or won't take the cash conversion of sales and pay it down. And when they do that, they start to carry a balance on their line of credit. And this is the part that gets people in trouble. When they start to carry a balance, that's when they get underwater, because we just took, say this is $50,000 on as a balance on a $100,000 line of credit. Now we only have room for $50,000 worth of stuff. So if I need $100,000 to meet my seasonal needs, I don't have it. I don't have access to it anymore. Think about a credit card in your pocket. If you got a $10,000 credit card and you're carrying, $5,000 balance, and you have a $7,000 repair to make, you're not going to have enough room. You're not going to be able to do that. It's the same thing with your line of credit. It's like a credit card for your business in that sense, right? So when that happens, that's when you get in trouble. Don't fret. If you're doing that right now, if you have clients that have that right now, the banks usually have a one-time get-out-of-jail-free card, right? they will actually take the balance that's on there. And I'll change this. They'll take the balance that's on there and turn it into a term loan. It's called terming it out. We're going to term your line. Some people think that's termination. We're going to close it down. No, that means they're going to convert the balance into a term loan, right, and free up the line on the, free up the actual balance. That's how you get into this position. They will take the balance, move it into your term loan. Oops. Take that balance, move it into your term loan here. Click back on it. There we go. No idea how that happened. And that's how you get back into the base level. If you're in that position, go to your bank, ask them if there's a way that they can term it out. Once you're in this position where you got your term loan, use your line of credit properly. Take the customer's money first, pay it back. Take your customer's money from your base level inventory and pay it back, right? Or replace it. That's how debt should be structured in a small business. If you're going to operate successfully, if you're going to have good relationships with the bank, structure debt that way. Term loans for the big stuff, term loan for your base level inventory, or line of credit for your actual seasonal needs, your adjustments. Okay, so there's debt structure. So let's go back to cause and effect. Everything impacts each other in this case, right? Everything has kind of an impact. So if I go back to using my sketch here, I go back to that. This is a chart that you can use to see what impacts what. All right. When we did our IFIs last week, we had misfinanced assets, and the misfinanced assets that he had was about $350,000. Right. If you go back to your IFIs, and that was I'm going to say 2 lessons ago, right before ratio analysis, we did trends, expense control, debt to equity, EBITDA, and misfinancing. And we found out that he was misfinanced for about $350,000, and he put them on his line of credit. And then I explained that one of the ways that we could fix that is move it off the line of credit, term it out, and actually frees up line on his line of credit, frees up money on his line of credit. When you have misfinanced assets, you're also going to have low cash. So if we start following these things around, you have low cash because you're making higher payments, right? Remember, misfinanced assets are the silent killers of business. It kills business by sucking out cash in the form of higher interest. So when you have low cash, you generally take on more debt. And he actually has about $1.2 million in debt between the long-term debt of $600, and he's got about a line of credit of about $600-700 as well, the short-term stuff. When you have a lot of debt, you also have a lot of high interest. He's paying about $129,000 a year in high interest. And then, of course, when you have high interest, you've got low net profit. And we found out today that he's actually got $209,000 there. So that's one way we can look at it. High debt is causing his low net profit. So if we can reduce the interest, it's actually going to have a positive impact on cash. Remember, we wanted him to cut $103,000 in high expense. That's part of where it's coming from right there. All right, so kind of working this around. We also said he has $322,000 too much inventory, right? And it's on the high side. We're higher, so we go this way. If he was lower, we go that way. But on the high side, we're going towards the high side. And in this case, a lot of inventory has high carrying cost. If you know what carrying cost is, because we have inventory, we also have costs associated with touching the inventory, ordering it, placing it, moving it, anything we have to do, keeping track of it. Carrying cost is what it takes to just have the inventory. More space, more people's time or whatever. These carrying costs are usually hidden in the operating expense. And I could spend probably 4 hours talking about how to calculate up carrying cost. In some cases, though, it's just 25% is a good average of the inventory. 25% of the inventory. In this case, I think that's about 85,000 or something. I'm kind of guessing. I can guess it, but it looks like it's about 85,000 in high carrying costs. So reducing the inventory actually puts more productivity in the workers' hands, and you can probably increase your expenses, increase your productivity, get more out of it, and capture about $85,000 in expenses by reducing the inventory. All right, so then we've got the accounts receivable. In our accounts receivable, we had the impact was 201. and we were lower, right? We're owed less. We're owed less than our competitors. So if I follow that around, of course, then low accounts receivables could contribute to low sales. And we have $1.2 million in low sales. How? Well, you got to remember, customers have an option, right? They got other people they can buy from. If you're the type of you know company that beats up on folks to make them pay faster, they might use other people's better terms. Better terms meaning you don't harass me as much. Even though you and your competitor have net 30, if you're giving them an invoice and then you're calling them the next day and then you're stopping by their house 2 weeks later, you're you'll email them and you're just kind of harassing them so they pay quicker, they might leave you, right? Or people may not choose you because of the way that you do business. So think about that. Low accounts receivable could be part of the contributing factor for low sales, right? Uh, and then again, I was talking about high inventory up there. If you have high inventory, you have low cash because it's sitting on the shelf, low cash, bank debt, high interest. Okay, low gross profit margin. All of these here contribute to low gross profit margin. The first one is maybe we're not taking advantage of discounts. 210 net 30 is the most common discount out there. And what that means is, hey, if you pay in 10 days, we'll give you 2% discount. Other than that, it's net 30, terms of net 30. In this case, if we got 2% on our cost of goods sold of 49.20, that's about $90,000 in discounts, right? That's real money, right? So if we had the cash, we could pay sooner and actually take 2% discount and save about 90K. The other things here, product mix, poor pricing, poor buying, those are all things that contribute to your cost of goods sold. Uh, After I sold my company in 2011, I consulted for Pioneer Human Services in Seattle. They are one of the top 5 providers of parts for Boeing in the world. And they make things like the vinyl lining on the inside of the airplanes, and they make escape hatches and those type of things. There's actually 2,500 parts. And what they saw is a steady decline in gross profit. And they couldn't figure out where it was coming from because they had set contracts, right? Set contracts with Boeing. Uh, there wasn't a change, in their mind, there wasn't a change in the pricing. So they're like, oh, I don't have any reason to believe that gross profit should be bad, except for the raw materials that they were buying actually contributing to the problem. Let me explain how. Well, we did an analysis of all 2,500. We came up with 119 products that were actually, they may as well taken a $50 bill, built the part, put the $50 bill on it, and gave it to Boeing. They were losing money on every single part to Boeing because the rise in the raw material had exceeded the cost that Boeing was paying for it. Now, there was no escalator in the contract, which meant that as the material cost increased, they should have been able to also increase the cost of the part to Boeing, and they didn't. They couldn't. They were at a fixed price. Now, what Boeing doesn't know is that they don't want to hurt people, right? They don't want to put businesses underwater. They don't want to make them lose money. All they do is when they look out across their vast network, they've got like 5 or 6 different providers of the same part, right? There's redundancies built in because they don't want to be, beholden to a vendor if the part doesn't get there. So they got 5 or 6 different options. They just look across the whole spectrum and say, who's cheapest today, and then press the order button, right? So that's what was happening. Well, if you're the cheapest, guess who's going to get the most orders? Well, you are. So they got flooded with these orders, and they were just making it thinking they were busy, when all the while they were digging a deeper and deeper, deeper hole. So product mix and pricing is very important. Product mix is also your loss leaders. Don't let your loss leader be your leader, right? Because again, you can't dig yourself out of a loss. You just make it bigger. The last one I always look for, though, is like shrinkage, inventory control, productivity. I make sure that the other things are right before I look for errors in bookkeeping, those type of things. Let's make sure everything else is right. If we still can't find where the problem is, maybe it's walking out your back door. Maybe we just made an error in the books. But we had a low gross profit margin of 106,000, which means we can contribute. He also has poor expense control of 103 that we need to cut. So that's how all of them relate. All of these things tie into the net profit. Now we know where to go look in order to get some of this money back into the company. So what were some of the problems that we found out as we look at this, what are some of the problems? All right. First of all, he's got too much inventory. So you got high inventory. Back to the high inventory. Real struggling there. Okay, the high inventory. And how do we reduce that? There's lots of ways to reduce high inventory. I mean, you could clearance it, you could discount it, you could give it away. The most common way is through attrition. I mean, just don't replace it, right? So attrition, okay. Don't replace. So that's one way we get down the high inventory. Another problem that he had is misfinanced, right? He bought some of his paint manufacturing equipment on his line of credit. So what we're going to do there is term the balance. Term out. LOC. All right, we're going to actually convert the balance on the line of credit into a term loan. That puts him back on track, reduces his interest cost. He's got low gross profit. So we want to, negotiate with vendors. You got high expenses, which will help with low net profit. Low net profit. And we want to cut 100K. Okay, something else that we found out about this company, of course, is that he has underutilized equipment, so low sales. No problem. So low sales, you just need to use it more, right? Put in a sales team. Put in a sales team. All right, so that's some wonderful writing. This thing's getting really hard to work with. I'm gonna have a new computer next time. Trust me. All right, so we've got all of these problems. Here's the point. We went through all of these, the ratio analysis, the financial impact to identify the problems. If you're going to be a trusted advisor, if you're going to work with your clients and you want to put them on the right path to profitability, this is a methodology you can use to find where the problems are, right? When you find the problems, you can also find the solutions and actually have a good conversation with your clients about how to improve the profitability of their client. So to end, let me just tell you how this played out. We already found out that he had all these problems. We didn't need to give him the loan, right? He requested $300,000, which we know he needed $500,000 based on the working capital cycle. He didn't really need any money. He just needed these things to happen. And then once those things happen, he'd be in a better position to actually take on a loan if he needed it. In the meantime, though, we had a meeting. We came back and we tried to explain to Sammy all of the reasons why we couldn't recommend him getting a loan, right? We couldn't recommend him going forward in the loan process. And it was just because of all these reasons. But we gave him solutions saying you actually have the cash sitting inside your company if we walk down through all these issues. This meeting lasted about 15 minutes, and it didn't matter what we said. Sammy was defiant. He was, argumentative. We told him he had too much inventory, and he'd make a joke about it. He'd say, "What do you think? Paint goes bad?" Paint don't go bad. It's like a pig farm around here. All we do is repigmentize it. he'd make funny jokes like that, but he just wouldn't listen. And after about 15 minutes, his wife, his son, me, and the banker were all in the room. After about 15 minutes. His wife slammed her hand on the table and she said, "That's it. I'm done." She looked at Sammy and said, "Sammy, I told you when we started this process that if it was easy, I was in. It's not easy. We've talked to 4 different banks. They've all come in here and told us the exact same thing, and you're just not listening." She goes, "I've been working with you for 30 years on this. I'm done." Right? Then she reached into the desk. She pulled out a piece of paper. And on this piece of paper, there were 3 names, right? People that she had talked to over the years. And she said, look, gave it to me. She said, Mike, I want you to sell this company. These are the people out there you talk to. She goes, I want you to find a way to go sell this company. We're done. We're not going forward with this. And the meeting was over, right? So no consulting for me, no loan for the bank. The meeting was done. The meeting was over, but we sold the company. I sold it in 45 days, right? We sold this company in 45 days. If you know anything about selling a company, it takes about 9 to 12 months. This one went in 45 days. And probably want to know how we did it. You want to know how much I charged for it and how much I paid for it. That's where this is a cliffhanger, right? Come back next week and I'll tell you exactly how that process went down. And then we'll wrap up this whole thing about how to use these techniques and our software, cashflowtool.com, to help your clients make more money. So, Chris, I'm going to turn it back over to you. Left you with a little cliffhanger. We got a little mystery going now. We sold this company, and we'll get it back to you now.
Right on. Thank you, Mike, and thank you everyone for attending today's session. As always, I'll follow up with an email, and hopefully I'll get it to you guys a little bit sooner than I did this time. I apologize about that. I'll try to get it to you by the end of the day today. Next up is lesson 6 of 6. So it is the final lesson, so make sure you come prepared to ask questions and say goodbye to Mike. And Mike, we're going to be bummed, at least I am. I don't know about everybody else, but I've learned a ton. So I really appreciate you taking the time to come out and, educate us. And I think you've been in a different state every single time that you've done this. So we really appreciate it. Thank you very much.
Yeah, I apologize. The equipment was bad this time. My computer shot craps over the weekend, so I'm using borrowed stuff, and it showed.
Hey, if I can tell your sunburn, it's not too bad. So
All
yeah,
right,
it
there
was
we go.
great. We could hear you. At least I could. So thank you.
All right, fair enough. Hey, thanks, everybody. We'll see you next week.
All right. Bye-bye.